Hey guys, what is up? It's Dusty here and welcome back to another episode of the Daily Crypto News. And guys, we just got ourselves some breaking crypto news here. Hopefully you guys have already checked it out. But apparently the stock market is moving down quite severely. It just opened up. Why? Well, we just got some very interesting news, guys. There's a couple of different pieces I want to share here, but this is definitely the most important. Just in, US CPI inflation hit 7.5% year over year. This, ladies and gentlemen, is one of the most significant, interesting, and important numbers that we're going to see in a very long while. So what this means, guys, is that on average, your basket of goods, CPI is the Consumer Price Index. What it basically stands for, so if you have a certain basket of goods over a year, so year over year, it has become 7.5% more expensive. Now, usually they actually try to lower this number down. Why? Because it basically shows the inflation, right? How more expensive things have become. The reason they try to numb those things down is because the lower the inflation looks, the more closely to about 2%, the quote unquote better. And how they do that is by basically using replacement goods. Now, there's a couple of rules and a couple of thoughts and theories we are not going to go too far into today. But apparently, for some strange reason, even with the previous CPI number that we talked about before here being 7.2%, I think, we already were quite confused as to why they didn't do that this time around. And why, while everybody was expecting the number to be severely downturned, they didn't do it too much. Or it could literally be so as well that the actual inflation, if we don't take into consideration all the downturning, would have actually been way higher even. What does this mean? Well, this basically means that if things have gone this bad, generally speaking, the prices have gone up by about 7.5% on average, which means you want to kind of combat these things becoming even more expensive. Usually, things becoming more expensive is a little bit of a loophole of things getting even more expensive and things getting out of control. We talked about this before. So the counter to this is increasing the interest rates. And you guys have already known for a couple of months now, because I've explained it 1,000 times, why that's very negative, right? If the interest rate increases, which is the rate hikes we've talked about a couple of times, everybody's negative about that. Why? Trump, for example, is very negative about it because generally speaking, if you're trying to innovate, do something, you need to borrow money. The cost of borrowing money becomes more expensive because the interest rate is higher. So the negative side about that is people, generally speaking, will save more. That's, again, the literal thought process between why you want this. People right now, when the prices are getting higher, they would rather spend money now than save it up for later because things are getting more expensive and because the interest rate is low. That's generally speaking the one-to-one. Right now, if the interest rate gets higher, you'd rather save up your money because you're getting an interest rate for that. And generally speaking, the prices go down because if people are spending less, if there's less innovation, there's, again, less job offers and whatnot, it kind of goes on a little circle. Things, generally speaking, get cheaper. And so you'd rather wait for your consumption. You're going to extend that, basically, or how do you say it? Postpone it, the postponement of consumption. And so generally speaking, that's very bad for stocks, very bad for everything in that market. Then again, this is also not nice for the dollar index and whatnot. And generally speaking here, we're trying to figure out and we're trying to calculate and look what the correlation is for crypto. But looking at the entire index here, let me actually put it up properly here so you guys can see it firmly. Like that, like this. You can see here, everything is looking red right now. Now, I'm not sure if this is actually a one-to-one correlation, that it's because of the stock market that this is happening, because again, it's really hard to put in. But as you guys know, we did not get the announcements for crazy rate hikes before. And so in theory, it could be that at any one of these weeks, any one of these months, we're going to get that crazy announcement of, hey, we're increasing the interest rate by a severe amount, which again, they haven't done just quite yet. And that's going to be the actual killer. The inflation percentage, we kind of already knew about. We kind of knew about everything in this nature already. It's just about exactly what's going to happen after this. Then again, a couple of guys are saying a lot of longs got liquidated. A lot of people actually lost money because the price went down severely. Some others are saying the price, it was already priced in, meaning people already anticipated that, and so the price already adjusted accordingly. It's definitely hard to say. I just know that because of this, guys, it is almost going to be inevitable that this year is going to be one that's filled with price hikes or with interest rate hikes. And what that again means, guys, is that most likely the market will react quite severely. We don't know whether that's going to be bullish or bearish, as I can make some arguments for both these cases. The reason it can be very bullish for the markets is because if the interest rate goes up, basically, every traditional investment instrument is doing bad. So it could, theoretically speaking, be that if the economy is going to do worse, again, if you have market cycles, this is basically the turning point of a market cycle. If everything traditional investments are doing bad, there's a very high probability that the hedge against that, which usually we call crypto, right, and the hedge against the normal traditional financial system, that would do good. The counter argument is, well, if investment vehicles as a whole do bad, there's a very high probability that an investment vehicle like a Bitcoin, like a cryptocurrency, would also do bad. Then again, guys, these videos are not financial advice. This is just purely my opinion, but I think there's some logical explanation behind everything that I'm saying right here. So having said that, does it really matter? That is also debatable because, as I said before, it is literally impossible to see the implications of whatever we're seeing here. It is just possible to presume a couple of things and understand what the implications could be for both sides and act accordingly. What I'm thinking, guys, is even though I still have my long positions open, the short that we talked about before as a hedge is more warranted now the more we get towards this final result, basically. So what I mean with that, let me actually open up real quick. I guess I'll do it like this. Let me quickly open up a Bybit link here. So the reason I want to do that real quick is to show you guys. Give me a second. Well, you know what? I can actually pause it as well. All right, and so you're right now in front of you seeing the Bybit chart. Generally speaking, I would say we are actually still bullish, just following what exactly happened over the last couple of days here. It really doesn't look too bearish just quite yet. We hit a little bit of a pitfall, but it really doesn't matter too much just quite yet, depending on how you view it. But I would say no. But what I was talking about, guys, is we have our long positions open for Bitcoin and for XRP. Let me actually put this into perspective perfectly. There we go. So a long position basically means you're expecting the prices to go up, and so we're using leveraged trades or leveraged contracts. Basically, we are putting in 10 times more money than we actually put in. What I mean with that, we open up $776 worth of our own money to actually open up a trade worth 7.7 thousand for Bitcoin. And the same thing for XRP. We put in $337 to open up $3,300 worth of XRP trades. And again, long, you can see here the quantity of the coin that we did it for. And the leverage is 10%. Isolated basically means it's not going to use additional of your balance. I would just suggest use isolated if you don't know anything about leverage trading, by the way. If you're going to make a choice about cross or isolated, use isolated because cross can mess your balance up if you don't know what you're doing. Long story short, that's it. It's going to basically take your balance to adjust your margin. So right now we're in 150% profit on our Bitcoin trade and almost 300% profit on our XRP trade still. But what my short hedge is all about, which again is more and more warranted the more we get into this uncertainty period, as we described before, is we basically short any entity, a Bitcoin, a stock, it doesn't really matter, an XRP, at one of these points. It doesn't really matter where exactly either. The reason we're doing that is because, generally speaking, Binance has advised this to all the people as well. The reason I'm saying advise literally is because it is a piece of financial advice that is to be taken in a couple of different contexts. What I mean with that is it's literal financial advice to protect your gains. It's not necessarily financial advice to short the certain market. It's the action and the thought process behind it. To take action to protect your investment, that's again financial advice literally. What action you're going to take, that's for yourself to decide and to do your own due diligence for. As again, I cannot say that this is going to be the best thing for you, nor that you should do it. What I can say and what I can guarantee you should do is always look for the best way to make sure that you don't lose a crazy amount of money, right? I mean, that's just logical common sense. What I can advise to anybody is protect your money. I think that makes a lot of sense. But how the shorting works is, let's say hypothetically speaking, that the price actually keeps on rising, right? And we did place a short. So a short, let me actually explain that first. A short right here plays, for example, over on Bybit. Right now there's $4,100 worth of bonuses, by the way, with the link down below. So actually, you can literally do this short for free potentially even. It's crazy. Check the link down below out for Bybit. But I digress. Let's say we open up a short. What we're basically saying is the price is from here going to go down. That's what we expect. Why? Well, because it can. Right? So we're basically saying we're gonna short, and if the price goes down, we make money. Why? Well, because we leveraged it, and the whole shorting process is actually borrowing and giving it back later while the price has changed. So basically, you're borrowing something, and you're basically giving it away. You're buying it back basically when the price is lower. So you basically take the money upon that difference. That's basically what shorting is in easier terms. But it's basically the same thing as you're expecting the price to fall down. Let's say you actually short right here and the price does fall down a little bit. Let's say it goes down about 7%, then you've made 70% profit because we do it with 10 times leverage, meaning we're doing it with 10 times more money than we have in actuality. The reason is, let's say the price did go up, right? We're gonna most likely make a lot more money on the tokens that we are holding. So basically we're good. But if the price comes down, like we've seen in a couple of these dip cases, our portfolio just crashes hard. So this short will only be beneficial to us if the price goes down and kind of negative to us if the price goes up. But the way off is if the prices go up, you're making a lot of money with your portfolio. If the prices come down, your portfolio is hurting even more severely. It's going to hurt even harder. So what this short is doing is basically protecting your investment from going down. And that's where the leveraged short comes in severely, because it will basically go exponential to some degree, for that you only have to basically short with a small amount of money, but make a lot of money if the price actually does come down hard, while still, if it goes to the upside, you're not really losing that much money because, again, your short just gets gone, but the amount of money you're making on your traditional crypto that you already have is going to be way more. If you don't understand the concept, or you don't understand at all what I'm saying, guys, I would highly recommend you to look into hedging and basically how bigger fund managers are doing it with their money. Another concept to go for, I guess, is to, because a lot of people said DCAing, and I told you all before, DCA is different because what you're doing is you're using basically different capital to increase your current stash at a sort of a lower average price. But then you're still in that same sort of asset. So if it goes down further, you're still hurting. Your average price is a little bit lower, yes, but your overall, all your money keeps going down. What the idea is with the short position is that if the prices do end up going down, you're not really severely hurt as much because you're making money on that. Then again, the downside is, guys, that if the prices go up really hard, you are losing out on that. So it needs to be a little bit of a balance where your short is not so severe that you're only making money when things go down. It should be that if the prices do end up going down, you're just not as hurt, but you're still losing money, I would say. It's just the short is there to prevent you from going really detrimental. A lot of people, actually, I recommend this too, as not financial advice, is people that are really irresponsible with their holdings. So they're, for example, all in crypto, and they would basically almost, suffer from, I don't know, they couldn't pay their rent anymore if the cryptos end up going down. Then again, in cases like that, a short might be warranted because if the prices do end up crashing severely, at least they're making a very, very big amount of money on their shorts to make sure they've learned to listen. Again, if the prices do end up keeping to go up here, it's a very bad idea. So it's a 50-50, I keep my long positions open for right now. However, I am putting up the strategy for you guys out there so you understand. There's two ways to go about this thing, and it's literally, if anybody's telling you right now that it's clear what's going to happen, that they're absolutely lying to you, I can put my hands in the fire for that, as it's severely, severely difficult to say. We have seen before that the Bitcoin correlation between the stock market and announcements like this is literally impossible to predict as well. At least, unless you might have, a couple $1 billion, you can manipulate the market. For all as retail, all as normal people, it is impossible to predict what's going to cause. As you've seen before, the announcement came out, price most likely crashed severely. Right now it's coming back up. Potentially because people came to the realization that it doesn't matter, but also potentially just because something else that we don't know. Right now we're facing a very big hurdle at $45,000 for Bitcoin. You could make the good argument that, guys, if we cross this and we get a confirmation candle on a 4-hour or higher, so 4-hour or higher, that's what I always like to go for. We actually have a confirmed bull case, and so we're going to buy in like crazy. And that could be within a couple of hours here, guys. Because here there's the $45,000 mark. Let's actually put a little barrier right there if I can. Should put one like this-ish, right? So again, how that usually works, what a lot of people do, is the moment it breaks out, this could be a breakout candle depending on how high it closes. The moment it confirms behind it, like this, then we start buying in, going in for a long position. And again, that might be the best idea for right now. You just understand the medium term here, that the interest rate hikes are going to come and nobody knows what's going to happen to crypto space. It's going to be a very big turmoil though. So I'm going to call this like breaking, maybe not urgent, because you guys said please don't do urgent. Then again, it's an update that's really relevant right now because the news just came out and the price could even do something crazy over the next couple of hours. As even though, again, it most likely already happened right here, it's still very relevant because we don't know how the stock market is going to react to this over the next couple of hours. And again, we don't know the correlation between the two. But I think they're very much correlated. We just don't know if it's going to be a literal one, so 1 to 1, or inverse, which is 1 to -1. So let us see. If you guys enjoyed this video, make sure you subscribe to the channel. And sorry if it's a little bit theoretical today. It's just I had to get a lot of thoughts out there because it's a very important situation. And as people of digital money, we should be interested in this type of stuff.